Welcome to an exciting exercise. We're going to use some T accounts in this exercise, but what we're going to do is we're going to analyze some basic stock transactions, and we're going to identify how we would plot these into T accounts. Okay, and let's see here, what do we have? Okay, so we can see the T accounts here. So we're going to have to deal with some cash, some preferred stock, some common stock, some treasury stock, and some additional paid-in capital. And looks like we're going to, no matter what type of additional paid-in capital we have, we're going to be using the same T account for it. So notice that we have, this is requirement C. Requirements A and B were for using a financial statement effects template and for some journal entries. And we have I have a similar exercise. The numbers are different, the dates are different, those kinds of things, but very, very similar that show you how to do that in a financial statement effects template and the journal entries, which is probably the most useful portion of that. So we're skipping past that and we're going to do the T accounts, which were not covered elsewhere. Okay, so on January the 15th, McNichols Corporation issued 25,000 shares of $5 par value common stock at $17 cash per share. Okay. So anytime we see the word issued, we know that if we're selling something, the money's coming in, and if we purchase something, the money's going out. But always remember that when you see the word issue, usually we are receiving cash. Now that's not always the case. Sometimes we're extinguishing debt when we issue something, but that's another story. So if we see the word issued, the money is usually coming in if cash is involved. Well, if cash is involved, it will always be coming in. So, how do we do this? Well, we're going to bring our calculator over here, and we're going to take 25,000, and we're going to multiply it by $17. That's going to give us $425,000, and that's how much cash we would receive. So we're going to go over here to the left side of cash, and I'm going to squeeze this in. That does say 1/15 there. You may not be able to read that, but I'm going to put my $425,000 there. Okay. However, we need to understand that this is in two pieces. So we've got a common stock portion and an additional paid-in capital portion, and we're going to do the common stock first. So our par value is $5, and we're going to multiply that by the 25,000 shares. That gives us 125,000. Common stock has a credit balance, so we're going to plot that there. So we've got a debit for 425 and a credit for 125. That means that our difference is 300,000, but don't take my word for it. I want you to take the full price of the stock, $17, and I want you to subtract the $5 par value from it, giving us $12, and we're going to multiply that $12 times 25,000. And there's our 300,000. And we're going to place that right here. So additional paid-in capital, and in this particular case for common stock. On January the 20th, we're going to issue some more stock, but this is going to be preferred stock, looks like. So 6,000 shares of $50 par value, 8% per stock at $78 cash per share. So what I want you to do is the exact same thing that we did for January the 15th, obviously with different numbers. So 6,000 shares times the sales price gives us the amount of cash that we will receive, $468,000. We're going to then take the par value of 50 times that same 6,000. If you went in the opposite order, you'll get the same answer. Okay, so 6,000 times 50 is $300,000. We're going to put that over here on preferred stock, $300,000. Okay, so we've got that figure in there. So for the 20th, we've got our $468,000 cash. We've got our $300 par amount for preferred stock. And so then what we have to do is we have to figure out how much additional paid-in capital we have. So we're going to take the full price, 78, minus the par value of 50 is going to give us 28. And we're simply going to multiply that by the 6,000. So we get 168,000, and we're going to put that figure right here. Okay. We could have just as easily said, well, you know what, I've got a $468,000 debit to cash, and I credited preferred stock for $300,000. So clearly, the difference between those is 168, and we could just plot it there. But the way we do it sometimes in the videos takes a little bit longer, but we'll get the right answer eventually. Notice we don't have to do anything with this 8%. That's the stated dividend amount of the preferred stock. It has nothing to do with anything that takes place at issuance. All right. On March the 31st, the company purchased 3,000 shares of its own common stock at $20 cash per share. We call this a treasury stock transaction. So all we have to do is we're going to take the 3,000 shares that we're buying back from the public for whatever reason, to use these as bonuses, to prop up the stock price. Kind of hard to say. We are getting more for them than what we originally, we're paying more for them than what we originally issued them for. So could be a variety of reasons here. But anyway, we're buying back 3,000 shares of our stock, and we're paying $20 a piece for those shares. Okay, so 60,000. We have $60,000 going out. Okay, and what do we get for that? We get $60,000 of treasury stock. Okay, so the cash is going out, so we have to use a credit for it to go down. Treasury stock is what we call a contra equity account. Contra equity account, or an adjustment to equity. So our retained earnings and then our contributed capital accounts, which is preferred stock, common stock, these all have credit balances. So this is flowing the other way. It's over here on the left, contra equity account. Okay, so we got the 60,000 here and the 60,000 here, and that's all we have to do. We also have a couple of transactions where we're going to then sell that treasury stock off. So it's very important to recognize that there's a couple of ways that we can account for treasury stock transactions, but by far the most common way is by something called the cost method. Cost method. So if I say something twice, it's probably important. So on June the 25th, we're going to sell 2,000 shares of our treasury stock at $26 a piece. Okay, so $26 is how much we're getting, and we're selling 2,000 of them. So this is an increase to cash for $52,000. Okay, now we're going to reduce, not reduce, well, I guess we are reducing. We're going to also take that 2,000 to reduce the treasury stock balance, and we're going to multiply that, though, not by 26, but by 20. And that gives us 40,000. So our reduction to common stock is $40,000. So we got our $40,000 reduction, and we got $52,000 cash. Sounds to me like we have a gain, right? Wrong. We're not allowed to recognize gains or losses on treasury stock transactions. So, but what we can do is we can say, okay, well, the cash is $52,000. That's more than the reduction. So this would be the difference between $52,000 cash and the $40,000 treasury stock that we went ahead and sold back to the public is $12,000. And so that would be a credit to additional paid in capital. All right. And then finally, on June the 15th, let's see here, on June the 15th, I'm sorry, July the, let's see here, I made a mistake here, didn't I? No wonder. $12,000 goes there. Let's see, I did everything else right. Yeah, but I almost made a mistake. Okay, and then on July the 15th, sold the remaining 1,000 treasury shares for $19 a share. So we're going to take our 1,000 shares times $19. That gives us $19,000. That's the amount of cash that we received. So we're going to squeeze $19,000 in right there. And then we have to reduce our treasury stock. We're going to use the original amount, just like we did right here. So 1,000 times 20 is 20,000. So the cash received, $19,000, is $1,000 less than the reduction to treasury stock. So we have a loss, right? Wrong. We're going to debit additional paid in capital for $1,000. So between those two transactions, our additional paid in capital between these two transactions right here actually went up $11,000. And most of the examples that you will see for this type of exercise we try to keep it with a credit balance, you know, for Accounting 1 or beginning financial accounting courses. Okay, so that is the how we would handle some basic stock transactions and how we would plot those into T accounts. Do be advised that we could have set up a separate additional paid in capital account for each one of these types of stock here. Okay, we could have done that to illustrate things a little bit more clearly. We didn't have that option, so we did it the way that we did it with, let's see here, with common stock, preferred stock, and then 2 treasury stock transactions in the additional paid in capital. All right, thanks for watching.